Okay, we should be live on Facebook. I do apologize. We had some technical difficulties. For some reason, my Zoom wanted to do an update and didn't warn me earlier. So I had to do the update in order to have my audio hooked up. So apologize for that, but certainly want to welcome everybody to this second installment of our series that we began on Monday of having relevant conversations in this current crisis. And so we appreciate you being here. We're a little overwhelmed, I guess, by the response that we had to the first meeting. We had some expectations that were just really beyond what we had thought originally. We had over 100 people on the phone call between Zoom and Facebook. And in addition to that, since then, we've had over 433 views of the video. So we're pretty excited about those who have chosen to participate and join us in the call today, those who are following us on Facebook Live, those of you who have gone back and have watched the video and have forwarded those videos on to people that you knew would be interested. And we just hope this community continues to open far and wide. We are excited about the possibilities. We're very grateful for those who have expressed their interest in participating. And we hope we continue to bring you those relevant topics, and we are very excited. We have a little bit of a change in our programming. We had announced on Monday that we were actually going to have the CEO and the president of a local bank on our webcast today. And due to the Paycheck protection program, which we'll talk about here in just a minute, we've had a little bit of hiccup there. And obviously they're drinking from a fire hose right now and just felt like they best needed to manage that and let us put them on at a later date. So a week from now, we'll have the bank on. So there's a little bit change in programming. On Monday, we'll have a group from Wealth South on as panelists. And then that following Thursday, next Thursday, we will have the bank on with us. But today, we're very excited that is someone that we have had in the queue and we wanted to bring on very early on, and they were gracious enough to fill in this time slot today. We're very excited to have you with us today, Todd. Todd Wetzel is the president of McGregor and Associates. McGregor and Associates has been a longtime community participant here in Lexington and in the greater Central Kentucky community since 1992. So they've been around for 28 years. They provide administration, compliance, and consulting services for employee benefit plans. And they work with all scales of business. So everything from small business owners that have a few employees to rather large businesses. And so we're really glad to have Todd on the program with us today. Todd lives here in Lexington. He is a graduate of Transylvania University. He grew up in Hardin County. So he's not a Lexington boy. Of course, neither am I. But we're glad that these are his roots and this is his home. And we're excited to be able to have him on the program today. So Todd, very much appreciate you joining us. Before we jump in directly to talk about the impact that the CARES Act has had on retirement and employee benefit plans, I just want Gwen to kind of bring us up to speed a little bit on the ever-changing landscape of the Paycheck Protection Program. Gwen, so if you'd like to kind of tell us some of these frustrations that we've been up against lately and explain that this landscape has changed even more, yeah, feel free to jump in and take us through
this week has been a little nutty. We're keeping up to date with everything that's going on with the rollout of the Paycheck Protection Program. And so we've had communications from clients that they've, sent us regarding what their banks are requesting, and it's kind of been all over the place. So, there's a couple of things that changed too from even what we talked about on Monday. So just wanted to update the things that we know for certain, because there still is a lot of uncertainty and a lot of kind of I don't want to say misinformation, but maybe not consistent information coming out from the program yet. So I'm sure all of that is getting figured out. There's a lot that goes into it. So the couple of things that we do know that has changed from what all the leading up information is that the terms of the loan have changed. So it looks like it's going to be a 2-year loan with a 0.5% interest rate. So that's quite a bit different than the 10-year up to 4% that had been published and discussed previously.
Yes.
The other thing that seems fairly certain is that applicants can start applying tomorrow. that the loans will start being processed tomorrow. I know the banks are working with clients to gather information and so that people are ready. And then we actually received information this afternoon and had not realized this from the AICPA that does indeed state that beginning tomorrow, April 3rd, that small businesses and sole proprietorships can apply. And they are urging you to go ahead and apply quickly. As well, starting April 10th, independent contractors and self-employed individuals. So we didn't realize that there was a difference in the application date, but this is, again, according to the AICPA and some things that they're putting out this afternoon, there appears to be a week-long difference between when the small businesses apply and when independent contractors apply.
Yeah. Well, it's been interesting and it's been frustrating, and we can only imagine what the bank is facing on their end. So even though we've had different banks give out different information, I'm sure they're trying to still digest this. So we want to give them a little bit of latitude in the process, and just everybody kind of relax from that standpoint, and just realize that there's probably a mad dash on the banks right now as everybody's trying to get in the front of the line. So I'm looking forward really to hearing how a local bank here is handling that, and maybe they can give us certainly much more of an insider's look to that, so that we'll learn to kind of take a step back and be gracious in the process as we're trying to work with them. But let's move on to talk with our panelists today. Todd, we appreciate that you're here. We understand that this CARES Act has definitely changed your world quite a bit at McGregor and Associates. So feel free to kind of jump in here about what some of your biggest challenges have been and the rush of the phone calls that you're having to deal with too. And then we'll get into some of the specifics that you would like to walk us through about some of those changes.
Right. Sure. Well, thanks so much for having me. I'm, glad to be included in what you're doing here and appreciate it very much. Yeah. The CARES Act, it's funny. We just had a Secure Act, pretty significant changes to the retirement plans, and everybody's forgotten. That basically went by the wayside as the CARES Act was passed. So obviously significant changes for small businesses, but then specifically in regards to benefits, both eligible expenses for FSAs, HSAs, and HRAs were impacted, and then some what we're calling relief for certain retirement plan provisions and waiving of penalties and that thing, so that, really Congress trying to make money available to people who are impacted, and the speed with which it was done and how information was sent out, as you said, has created a lot of questions immediately. So we're digesting the information and trying to put it together in a concise format to be able to give people a perspective on what's available to them and their employees in the near term because of all of this happening so quickly.
Yeah. Well, let me ask just kind of overall, even though we definitely have some very specific changes that are being made, but I would imagine there's somewhat of an asterisk on a lot of these that it's pending further guidance. Are you seeing the same thing from your end that we're seeing on our end with a lot of these changes?
With almost all retirement plan laws that Congress passes, the IRS, the Department of Labor, are obligated to come behind them with regulations, and that's normally a slow process. Yeah. Both the Department of Labor and the United States Treasury have been given authority to provide additional guidance. So there are certainly areas where we are expecting that, and actually rather quickly, some clarifications on certain provisions. Right now, we're in a place where we've got the big picture and we kind of have an idea of what is allowed, but we will be looking for those clarifications, and that they'll be helpful as we move forward.
Well, I know one of the, I was going to say, one of the things that a lot of people are interested in is, just the relief on the 10% penalty in regards to, being able to withdraw money from your retirement plan. So one of the things that, I've been curious about is it has to be a coronavirus related distribution, but it seems like we're all affected by coronavirus. So can you kind of talk a little bit more about, how are you going to determine and who's responsible for determining whether or not these, this is a coronavirus related distribution when people draw out money?
Right. So basically, if you have a retirement plan, then you have some choices to make immediately. As Gwen said, to make money available to participants who might meet certain criteria. And I prepared one slide, and I'm going to talk about it briefly, and then I'll put it up to kind of go along with that today, because it is quite a bit of information. But basically, the way that the law is written is you have to be impacted. So you have to either be diagnosed with the coronavirus by a approved test from the CDC. You have to be, or you can be the spouse of someone who has been diagnosed to be considered an eligible person, or you're affected by, and that's really what I want to share with you is, the affected by part of this, because it does give a little list of things that would allow someone to qualify for that type of relief. So let me share my screen just briefly and kind of show you what's here. So in this section down here of who qualifies, you can be, it says adverse financial consequences. So that's pretty specific. If you are quarantined, furloughed, laid off, hours reduced, unable to work due to childcare, closing a business, or other factors determined by the Secretary of Treasury. And that is one place we're looking for additional guidance. The Secretary of Treasury might actually come out with other things. So those are the reasons. So obviously the simple stuff is, simple to determine is, did somebody test positive, or the spouse or eligible dependent of someone who tested positive. But then I think the broader one that will probably require some further guidance or interpretation is who has an adverse financial consequence because of that. So clearly an easy one would be somebody that's laid off and is not working and is not getting a paycheck. The more interesting part, and when you mentioned this, is the way the law is written is that the plan may rely on a participant self-certification that they meet one of the criteria. There are very few things in the retirement plan law outside of like an employee electing to participate in a 401k plan. There's very few things in the law that the employee is allowed to certify on their own eligibility for something like this. And so that is pretty unique, and I think will, in my opinion, give sponsors of plans, it should give you a little comfort that they're not going to throw the book at you for allowing distributions out during this time. If the participant can self-certify, we do think it's going to be an immediate best practice to have the participant sign something to self-certify. So, a form or something that says, yes, I meet one of these criteria. But that does make it a little bit more liberal in terms of how this is going to play out and who's going to be able to access money from their retirement plan.
Now, these retirement plans that we're talking about, pretty much 401k plans, 403b plans. There's no distinction. We have one question that has been raised, and I think you've really kind of already probably answered, but I just want to make sure we clarify for anybody that's raising these questions. It has nothing to do with whether that's Roth 401k, traditional 401k. It's just all across the board, 401k, 403b plans, correct?
That is correct. There is no distinction between Roth and pre-tax. Basically, any qualified retirement plan, there is access.
Okay. Just want to
One
make
thing
sure
that I thought was interesting about the law is that they took away the mandatory withholding. So at least from a prepare standpoint, I think sometimes when people pull on their 401k plans, there's obviously a need because they, that's not the first place that usually you're going to try and liquidate. So if you pull on those, absent the 10%, you still owe the federal tax. So a lot of times 20% doesn't quite cover what the tax is that you're going to owe. So people end up getting surprised because they'll come in and say, well, I had withholding on that, so I should be fine. So that's one thing, about, how are you handling, like advising people on what they should do as far as withholding?
Yeah, so it is the distinction in the law is whether or not the distribution is eligible for rollover. And if it's not eligible for rollover, there's not mandatory withholding. And so in this case, obviously, if you need the money because of financial circumstances, then they're not going to make you withhold. We normally counsel the employees of our clients to consider tax withholding, and if they're not comfortable with those choices, to consult with a tax advisor, because it can be a pretty big hit. And we haven't said it yet, but the limit on these are up to $100,000. So that could be a pretty big tax hit, completely change your tax situation for the year. So our recommendation is to provide the participant the opportunity to elect tax withholding. And if you happen to be the person who is talking to them about the withdrawal, just mentioning it to them. Another important distinction, all retirement plan distributions that have tax as an option have a required notice to the employee that talks about the taxation and tax options. The notice is not required because the tax withholding is not required. Internally, we've decided we're probably going to go ahead and provide the notice. It's useful information, and employees can read it to the extent they want to and try to understand how the distribution might impact their tax. We see, like on hardship distributions, anything, a lot of people just choose 10%. They think, oh, there's a 10% penalty, I'll do a 10% withholding, but you can do any amount you want. I do not think you can gross up the distribution, however, for taxes. I think it is a hard limit at 100,000, which is different than like a hardship distribution.
Okay, so meaning that, if they're choosing to gross it up 20%, hit that 100,000 mark, then they're really only going to be taking away 80, grossing it up for the 20 to cover the taxes, is what you're saying.
Yeah, it's 84,000 or whatever that number is, right?
Yeah, whatever
so if you're going to withhold tax, you have to take that in consideration of the limit.
Right, but let me ask you a question though, because part of the tax legislation says that this income can be recognizable, right, on these particular distributions over 3 years.
That's correct.
Okay, so if we've got if we take the position that we're going to have it grossed up for withholdings, then potentially, unless there's another calculation in play, we're going to have a withholding nut that's trying to cover the entire distribution, even though only a portion of it's going to be taxed in that particular year. So we used the example last time, if somebody takes out $60,000 and they're having to, over that 3-year period of time, recognize $20,000, yet they withhold enough tax to cover that entire 3 years, then they have to recognize what's going on there.
Yeah, or be disciplined to take the other part and put it in a savings account for the next 2 years.
Yeah, exactly.
Right. So
we're all good at that.
So that's definitely something that has to be factored in here.
Absolutely. Absolutely.
Now, which begs the question on the other side. We know that there has been provisions made that distribution can be paid back into the plan, correct? And then therefore qualify it as if it was a rollover.
That's right. So within a 3-year period also, basically the same 3-year period, it may be repaid to a plan to avoid taxation altogether.
Okay. So would that pretty much allow for kind of like a dollar for dollar match as you go along? So if you're recognizing $20,000 the first year in income, you want to contribute $20,000 to completely wash out any tax effect? Is that how that mechanics are going to work?
Absolutely, you could. It's our understanding that it's ordinary income out, so it would a contribution back in would get the ordinary tax favorable deduction. Okay,
but what if that first year you don't make the 20, and you reserve the 60 over the next 2 years? Past the first year, so year 2 and 3 is, that's you've got an eligible rollover portion that meets the overall withdrawal, but yet, you see I'm going with that?
Well, in terms of the tax, I don't know that there's a big impact as long as you pay it back, in any amount, then.
Well, I know, but I think I'm assuming that you're not paying anything back the first year. No, you're picking up the 20 in income. You're not paying anything back. So you can expect to get taxed on the 20. Let's say year 2, you decide to pay 40 of it back, but you're only taxed on 20.
I see. Yeah.
Or you would potentially only be taxed on 20. So now you've got, 20 in income, but you've got 40 now being counted as the rollover. Do we know how the mechanics of that are going to work?
Yeah, well, no, I think in that example, in the second year, you wouldn't have the 20,000 taken into income because you paid it back. It would
Right.
offset.
Right. But the additional 20 that gets counted toward the rollover is you kind of lost your ability to push that into the next year to count toward that distribution, correct?
Yeah, I think so.
Okay.
That is probably something we'll need clarification on. If
All right.
you don't make a full payment back, or the timing of when you pay it back, that could be an outstanding question for sure. That
Okay.
needs to be
Well,
addressed
I
by the IRS.
anticipate that question. Nobody's raised it yet, but
Yeah.
I just anticipate that some of the mechanics are going to be what we have to work through as we're advising a client so that they don't come into year 3, or whatever, or maybe in year 1, whatever that timing or spread may be. And then they have this misunderstanding about how that's going to work.
Yeah, we will need guidance on that for sure.
Okay. I think that's important. You
Right.
did mention earlier, I think you already covered, just to make sure, this distribution has to be Corona related, correct? So you were advising that even though there's no formal documentation right now from the Department of Labor, an employer still should be prudent, correct? And making sure that they somehow, even though it's a self-certification, that doesn't relieve the employer of having some kind of documentation just to kind of cover their bases, correct?
Documentation, yes, I agree, but that could be a simple participant consent form.
Okay.
The way it's written, the word may
Right.
is used in the law. The plan may rely on a participant self-certification. So I
Okay.
take that to be the employer has no responsibility as long as they have the employee. And I think our clients, some are paternalistic and will counsel employees through this, and some are more hands-off and say you're on your own for these type of things, and the form will be good enough. So I think in practice, we'll see both ways.
Okay. That's good.
Todd, there were also changes to the required minimum distributions. So is that, they've been waived for 2020 as far as requiring, is that for all plans?
There is an exception actually for defined benefit plans. So it applies to 401k, profit sharing, 403A, 403B, governmental 457 plans, IRAs, but not defined benefit plans. So there's not a ton of defined benefit plans out there anymore, but cash balance plans have become much more popular, and those are certainly defined benefit plans. So to the extent you have a required minimum distribution from a defined benefit plan, that will still need to occur.
Okay.
Yeah, I don't think that I realized that had been carved out. So
Right.
when I saw your information, I thought that was important to point out. So
And that may be the rare exception, correct? I mean, because not a lot of those exist, and even the ones that exist now, fairly new, and are normally bolted on top of a 401k plan that's already in existence. So
that is correct.
If you've got two into play, so you've got your traditional 401k, obviously you can tap into that. You're just not going to be able to tap into that second tier if you're a participant in a defined benefit plan. Okay.
That's right.
All right. Well, speaking of,
go ahead.
Go ahead.
Sorry.
No.
Well, I would say just in regard to distributions, kind of the big picture on what we're calling the relief for participants. So there is a withdrawal available that we talked about up to $100,000, not subject to 10% penalty, no mandatory tax withholding, liability spread over 3 years. So that's one. That's a distribution that does not have to be paid back as long as you are, quote, an eligible participant, which is the slide I put up.
Okay.
But then there's also loan relief. To the extent that your plan offers loans, they've also provided some relief in regards to those. So the old loan limit was 50% of your account balance up to $50,000. That has been raised for 180 days only. So now through September 23rd to $100,000 and 100% of your vested balance. So to the extent a participant wants to take a new loan, they can now go up to 100,000, 100%. In addition, and this is the one we're getting the most questions on, is if you have an existing loan, you can actually delay payments for up to 1 year right now. Again, this is in the case of what is called an eligible participant, and an eligible participant still has to meet one of those reasons. However, what we are seeing and where the questions are coming from is we have clients who have laid off employees. It is clearly due to the coronavirus, and clearly there are adverse financial effects on that employee by being laid off. So the question is, can I stop loan payments? Obviously, if you're not getting paid, you're not going to withhold loan payments, but generally loans go in default without some other circumstance happening. So this is a waiver of the default. The one thing to note is interest continues to accrue. So all loans will have to be reamortized for whatever the missed or delayed period is. It gets tacked on the end. And so there's a reamortization of the loan. But it's pretty nice relief for participants who are making loan payments. And that is really the majority of the questions we've gotten this week have been in regards to loans. Another quick note, if your plan does not offer loans, this law did not say everybody has loans. So if you don't have a loan policy, you don't all of a sudden have a loan policy. Of course, you could add it. That would be a plan amendment. And then a second plan amendment would be making these things available. But for now, it's immediately available to anyone who has loans in their plan, and then the formal plan amendment can come sometime in the future.
Yeah, that's one question I've already had is there anything in the CARES Act that requires a plan administrator or a plan to have to, amend and adopt? And there's really not, right? It's just,
so that's another important note. All of the things we've talked about so far are optional at the discretion of the sponsor of the plan or the company that's sponsoring the plan. So you don't have to make distributions for coronavirus eligible. You don't have to make additional loan limits available. However, we have actually already seen record keepers, and let me just briefly talk about what I mean by that. So in the retirement plan world, most people have their plan with a record keeper, which is a mutual fund company or a financial services company or an insurance company that physically holds the money, and that's the website where people go to see their balances. We've already seen two record keepers today say that these provisions are available unless the client opts out. So they did not take an opt-in position on these. The record keepers at their own discretion took an opt-out position. Just to be aware, this requires a plan amendment. And so somebody needs to keep track of the fact that this is going on and record what options are being made available so the plan amendment can be done later properly. So things are moving really, really fast. We were a little surprised to see that. We understand the intent. We've also seen, which is really cool, record keepers waiving fees for these distributions. So most record keepers and administrators have fees for distributions and loans. And we've seen two record keepers come out today and say they are waiving participant fees for these type of transactions, which is very cool.
Yeah, that's pretty neat that they're, trying to make it accessible and available and easy and not trying to profit.
If I can, I want to back up on one point that you made, because I'm just thinking about a client in the current situation that had existing loans from their 401ks. And I just want to make sure if we could clarify that one more time, because I just want to make sure for my sake I don't miss it for sure, but also in case they're participating on this call. So they've had loans that were in play prior to the corona-related virus. So what's their options with those loans currently?
A participant who has an existing loan.
Right.
Yeah, a participant who has an existing loan can choose to delay payments for up to 1 year. The employer has to say that option is available.
Okay.
But once the option is available for everyone who has a loan, then the participant can choose to have their loan payments suspended.
And
I got the question, and just one brief example is, let's say they're furloughing on some kind of rotating basis. So you're working 1 week and you're off 1 week to save money, to do social distancing, whatever that is. I think this is where that applies more than a full layoff.
Okay. Now, so if they took that option and they made that available, is that a required amendment? not an acquired amendment in the
Yes.
plan?
So sometime later, the amendments aren't available now, but sometime in the
Okay.
future, by the end of the year, most likely,
Okay.
there would be a plan amendment that says we made these options available.
Okay. So
We
they can act on it now. And I think that's what I was wanting to make sure I was clear on. They can act on it now, even though the amendments aren't available.
That's right.
Down the road, they can come back and said, we made that option available and we took advantage of that option.
Yeah, we're
Okay.
today sending an email to our clients with an election form essentially that says
All right.
we want to make the following available. And so they'll be able to fill that out, send us back to us. We've got the record. We'll do the amendment when it's available sometime later this year.
Okay, very good. One other question I have as it relates to, of course, we have several clients that, and we talked about some of the due date issues with, them being extended. And of course, we certainly have the original due date of tax returns extended for partnerships. Well, no, partnerships, S corporations, they ended up getting stuck with the March 15th deadline, but we have others, that have the 4/15 deadline. I don't have a lot of clients who end up making any kind of a profit sharing, maybe not even a profit sharing decision too immediately into the front of the year. They'll make that decision, but then they'll choose to pay that out in installments all the way up to the extended deadlines. And so they'll wait until either to make a full decision and start trickling money into that to start covering it, maybe by 9/15 or 10/15. One of the things that they have, and just correct me if I'm wrong, they may want to reconsider, given the current circumstances, whether one, they want to continue, whether they want to fully fund that profit sharing plan. Number two, if they've already made installments, they can stop. But what about those installments already being made? Have already been made. So say they, February, March, and then they coming up on April's installment where they would normally traditionally spread those out. What's their recourse? Any?
Yeah, unfortunately, no. Once the money's in the plan, there's not really a mechanism to withdraw it unless you fail a test or violate a regulation. So I actually had a client made a pretty good sized profit sharing contribution in early March, trying to beat the March 15th deadline, and then called me when he had to lay off his workers and say, man, it'd be nice to have that money back. And unfortunately, there's just not a mechanism. And you kind of raised an issue about installments that I would just be careful about. A final contribution has to be allocated properly by the formula. So you might have in mind, I'm going to put in 10% for everybody, and you're going to pay $10,000 a month until the 10%'s in. Well, if you decide to stop, you're going to have to true up what's already been contributed.
Right.
There
Thank you
needs
for
to be
making
a
that
proper allocation of whatever the final number is. And it's definitely okay to stop for discretionary contributions. I have another client who was making profit sharing contributions each paycheck, which is pretty unusual, but they do it like a fringe benefit this year. So it's 2020 money. They stopped. And again, because it's discretionary, it's okay. We will true it up at the end of the year to make sure that it was done in the proper, by the allocation formula for every employee.
Right. And I think that's an important point, especially for cash flow purposes. If that has been your practice in the past, you may want to rethink that until we kind of get out of this environment.
I was going to say, we may see some employers who have that practice change, just having gone through this experience now, that they would want to wait until it's all available, until they're set on the dollar amount, it's there and they can fund it, which will be up to the deadline for many of them. So you might see a change in behavior for sure.
Yeah. Well, Todd, I know we kind of got off to a little bit of a late start here. We're trying to keep these to 30 minutes. So I know there's probably a significant amount of more that you can cover, but I think there is one thing that we had talked about that would probably be an important item, maybe not as important as these, but as it related to some of the changes that affect some of the old rules about over-the-counter things with HSAs and medical savings plans. If you want to comment on that real quickly, and then we'll wrap up.
Sure. Yeah. So over-the-counter medications are immediately eligible to be claimed for tax-favored treatments from flexible spending accounts, health savings accounts, and health reimbursement arrangements. Okay. In addition, they added menstrual products for the first time. That's never been a part of the law. So over-the-counter was available several years ago. They got rid of it. That was back immediately. One important just reminder is so many people use some type of debit card issued by their administrator for those now. Those have a smart chip in it that actually can read SKU codes. Those systems aren't up to date. So most likely, if you go to a retailer and try to buy Advil, it will not pop up on your card as an eligible FSA expense. So you'll just have to pay for it separately, and then you can turn in the receipt to your administrator. So we are equipped, our systems are equipped, but the cards aren't there yet. We have already seen the card managers put out information. They're working on it, but that's a big net to cast. But sure, that is a welcome relief for a lot of people who are now finding themselves trying to save money any way they can to be able to use those FSA dollars for over-the-counter medication.
Right. Well, there's so many people that have shifted to the FSA and the HSA. I mean, so there's a lot that has shifted in the marketplace as far as that's concerned. So that's certainly a welcome change, no doubt.
Right.
Well, we certainly appreciate your time, and it was just honorable of you to jump into this time slot and to give us the opportunity to move you up into that time slot. It's very timely, so we know that we're starting to fielding some of those questions. So I'm glad we could bring you on even earlier than what we had planned on doing, and we appreciate you doing that for us.
Well, thank you. Thanks for having me.
We will be sure, as we have said in the past, we're going to include some notes and some handouts, and we'll definitely point your guys' website into our notes in our YouTube channel. If anybody needs to reach out and ask you any more questions or talk to you about anything further. So we'll make that available. And of course, the recording should be made available a little later on tonight or tomorrow. So be on the lookout for that, and we'll try to send you a notice out for that. If you've not gone to YouTube to look at the channel that we have created, even before I get the notice out that the file is uploaded, if you'll subscribe to our YouTube channel, you'll get an instant notification the minute those videos hit. So we would encourage you to do that, and you'll be able to move on that much more quickly than what I'm probably going to be able to roll out the communication. But Todd, one of the things we've been wanting to do with this series and is to, our whole goal is just to make this very community-based, very real, even though I know we're dealing with a lot of technical topics in the front end of this series. We do plan to get and relax a little bit and bring on some other voices that are going to deal with other maybe non-technical issues. But one thing we want to give our participants that come on the call the opportunity to do is just kind of share some things, because we've all been impacted by this in very personal ways. And I'm just curious if you're willing to share, in this whole crisis that we've been facing, we're just trying to think through what each of our lessons have been and takeaways have been. And if you're willing to share those, I'd love to hear them.
Yeah, thanks for the opportunity. For me, it's family. And that it's a little cliche, extend to my staff as well. But, it's an opportunity to be home. Everything got shut down. My kids played soccer and they did gymnastics. And so we played a heated game of Uno last night. I did not win.
You did not win.
I'll just leave it at that. So that's been good. As a separate challenge, just managing screen time, like we call it with the kids. There's a tendency to be like, oh, we did our work, let's go camp. So we've been trying to be intentional about using this time. Of course, we're fighting the fights about playing with friends and being out in the neighborhood and that sort of thing. So, but then also for my staff, there's 21 of us. We have everybody working at home, which is a blessing to be able to do that. We have a daily manager on duty, so just to be able to care for them in that way also has been good. And we have a technology partner that helped make that happen. But overall, just the work is there's a lot going on with the new regulations, but just home outside of anxiety or something that might come with a pandemic, the time with family it's just been good.
Oh, very good. Glad to hear it. And I know we all share that sentiment too, even though some of us have not been able to enjoy it as much as others, but nonetheless, it certainly does bring it to light. So I appreciate you sharing that kind of personal moment, and I'm sure our audience does too. So we want to invite everybody to come back with us on Monday. We'll have some investment advisors on, and I'm sure a lot of people have questions about the market. that we're all having to live and struggle with, and whether there's any hope on the other side of it. And I think we'll have some encouraging news from them as they put that in context for us. So we definitely want to invite you back on Monday at 2:00, everybody. And we appreciate your time today. Thank you for being willing to spend that with us. And we just hope that you're willing to come back and open the door for other people and invite other people to join and participate in this forum that we feel is incredibly important. And we want to make available to everybody, not just our clients, but for this particular Lexington community. And we appreciate it so much. Todd, thank you again. Gwen, I appreciate you as always. And we'll see everybody on Monday. Everybody have a great and blessed day. Thank you.
Thanks.